Jeremy Grantham, an investor famous for calling market bubbles, said yesterday that historic stock crash he predicted a year ago is underway and even Federal Reserve intervention cannot prevent a near 50% crash. Grantham describes US equities as being in a superbubble. As happened in the crash of 1929, the dot-com crash of 2000 and the financial crisis of 2008, the investor is certain that this bubble will burst. This implies and warns that the Standard Poor's 500 will drop about 45% since the close on Wednesday and 48% since the peak of January 4, 2022 to a level of 2,500 points. From very likely a year ago to almost certain today. I wasn't as sure about this bubble a year ago as I was in the 2000 tech bubble, or as I was in the 2007 housing bubble, Grantham said in an interview with Bloomberg. But I felt it was very likely. Today I feel it's almost certain. And what's the procedure if really the Standard Poor's will lost 50%? 50% is a future price of Standard Poor's around 2,500 points. It's a very big turn down, but is not uncommon because if you go rare on the chart, historic chart, we can see that in the 2000 we have a crisis of the dot-com. 2007 we have a crisis of the real estate, and 1987 we have another crash on July, the Black Friday, and 1973 we have another crash for the petroleum or oil, and the last is the 1929, the big crash. The price of the Standard Poor's go down from around 30 points to 5 points in 3 years. So this is a big, very large trend down. But if we use the super range indicator that you can see on the website at tradingsystem.com, the big then round that the Jeremy Grantham said around 50% is a reasonable then round because we use the hedging mode, and sure our account will not lose 50%, and we can use the mediation for using others trades, and we can beat this trend down if it come or coming, and I don't know if this trend down will be or not, but it's better at this time to stop to buy every as described in the book, to buy every around 300 points one contract of this strategy. I think it's better wait 1 or 2 weeks and see what happened, because if the crash is fast is better. If the crash is very slowly, the trend down on Standard Poor's 500 is around from 2 to 4 or 5 years, and it's a very long time to stay with this index. I prefer that the Standard Poor's crashes fast for to buy new contracts. If we're using the strategy described on the indicator and on the book, 50% is not a big problem, because 50% of the drawn is equal around 10-20%. But if the drawn is very slowy, this may be a problem, because we have not to buy and earn every week. So, but this is near impossible, because if the drawn is fast, we waiting that this finish and we start to buying a new contract. If the Standard Poor's then drawn will be slowy, we will be opportunities to buy every month something. So we can to see what happening, and my strategy will be available on the website. And with this strategy you can sleep soft, because there are no big drawn if you setting as in the book. Okay.